Welcome to The Explainer. Today, we're unpacking a really fascinating puzzle in the financial markets. We're looking at Dynex Capital, a well-known real estate investment trust, or REIT, and we're digging into their first quarter 2026 earnings. On the surface, the numbers look pretty alarming, but as we dive into the data, we're finding this incredible dichotomy between their headline losses and their underlying financial strength. So if you've ever wondered how a company can look like it's bleeding cash while secretly building an absolute fortress for the future, well, you are definitely in the right place.
All right, we have to start with the harsh reality, the number that immediately grabbed all the headlines. A massive $83 million net loss for the first quarter. For any investor, seeing an $83 million comprehensive loss to common shareholders, yeah, that's enough to make you spill your morning coffee. It's a massive hit.
So, to figure out how they're still claiming to operate from a position of strength, here is our roadmap. We'll look at the headline loss, widening mortgage spreads, core earnings, capital and growth, and finally, management's long-term outlook.
Section 1, Q1 2026, the headline loss. Let's look closely at what initially startled the market. On April 20th, 2026, Dynex filed their 8K report revealing this startling loss. Now, as a REIT, Dynex has a long, solid track record of generating dividends from high-quality mortgage assets. I mean, their entire core business is buying mortgage-backed securities and earning the interest. So when a company built specifically around generating steady income drops a major loss like this, it demands our immediate attention.
Just take a look at the book value metrics here. The net worth of the company per share dropped from $13.45 at the end of 2025 down to $12.60 by March 31st, 2026. That is an 85-cent drop in just 3 months. Now, they did declare a 51-cent dividend, which, softens the blow for investors a bit. But when you net it all out, the total economic return for the quarter was a negative 34 cents per share. Basically, a negative 2.5% return on their beginning book value.
Section 2. The culprit, widening mortgage spreads. So what exactly happened here?
Well, it wasn't because homeowners suddenly stopped paying their mortgages. The culprit is something far more systemic. We need to understand this concept of widening mortgage spreads. This is a market shift where the yield on mortgage-backed securities actually increases relative to benchmark interest rates like U.S. Treasuries. When yields go up, the price of existing bonds goes down. It's a fundamental rule of finance. So as those spreads widened late in the first quarter, the current on-paper value of Dynex's existing portfolio just dropped. But here is the secret. While it lowers the current value of the assets they already own, wider spreads actually create much better, higher-yielding buying opportunities for new investments. It's like a silver lining.
You can literally see the impact right here. Notice that massive $140 million net loss on their investment portfolio, net of hedges. This was driven entirely by those widening spreads repricing their assets downward. This $140 million on-paper markdown, that's the heavy anchor that dragged their overall net income down to that negative $83 million headline number we saw a minute ago.
Section 3. Core earnings, the silver lining. Because paper losses are one thing, but what is the actual cash engine doing behind the scenes?
All right, here is the vital plot twist. Compare the official GAAP net loss of $83 million, which, remember, is heavily skewed by those temporary on-paper portfolio drops, with their earnings available for distribution, or EAD. That came in at a positive $61.8 million. Now, EAD is a non-GAAP measure, sure, but for REIT investors, it's often the truest gauge of cash-like recurring earnings from their core net interest income. What this tells us is that the day-to-day business of borrowing money to buy income-producing mortgages is actually incredibly healthy.
And honestly, it's not just healthy, it is growing rapidly. In the fourth quarter of 2025, they generated 22 cents per share in core earnings. Just 1 quarter later, look at how that jumped to 31 cents per common share. Their core earning power actually strengthened significantly, directly contradicting the whole narrative of that headline loss. Net interest income surged to over $79 million as their average asset balances increased and their effective yield stayed really strong, hovering right near 5%.
Section 4. Scaling up, capital and growth. If your assets are dropping in value, human instinct is to run and hide. But let's see how Dynex handled it.
Instead of getting defensive over their paper losses, management basically hit the gas pedal. They aggressively expanded, adding a staggering $6 billion in net investment purchases to their portfolio during the first quarter. Think about what we just talked about with widening spreads. It hurts the assets you already own, but it makes new assets so much cheaper and more profitable to buy. Dynex saw blood in the water and went on a $6 billion shopping spree.
So you might be wondering, how exactly does a company report an $83 million loss and still afford a massive expansion like that? Well, first, they raised $442 million in fresh cash by issuing new common equity. Second, they utilized debt. Their leverage ratio increased to 8.6 times their equity. Third, and this is a fantastic tailwind for them, their borrowing costs actually went down. Thanks to the Federal Reserve cutting rates in 2025, Dynex's repurchase funding costs declined 33 basis points, down to 3.8%. Cheaper borrowing to buy higher-yielding assets, that is literally the ultimate recipe for profit. And lastly, they didn't just blindly bet the farm, they maintained a highly disciplined $1.3 billion liquidity buffer, which is equal to 46% of their total equity.
To sum up this incredible balancing act, we turn to our analyst insights. You absolutely cannot ignore the real $140 million paper hit to the portfolio, or the drop in book value down to $12.60 per share. That is real shareholder value that eroded in Q1. But on the flip side, their core cash engine is just roaring. Core earnings jumped to nearly $62 million, and their scale expanded massively with $6 billion in new, higher-yielding assets. They essentially took a short-term hit to position themselves for massive long-term cash flow. Section 5, Management's Long-Term Outlook. Let's see if the leadership's tone actually matches all this data we've just uncovered. Take a look at this quote from the Co-Chief Executive Officer, Smriti Laxman-Popenoe. She states, Dynex entered 2026 from a position of strength, building on the momentum of an outstanding 2025 through disciplined execution and rigorous risk management. Now, if you only read the headline about an $83 million loss, this quote would sound like empty corporate spin, right? But after uncovering that 31 cents per share in core earnings and that $6 billion strategic asset deployment funded by cheaper debt, this statement actually feels completely earned. They took the pain of the market spread on the chin and used it as leverage to grow.
If management's timing is right, this quarter's paper loss is simply the setup for tomorrow's massive cash generation. The ultimate question you need to walk away with is this. Will this highly levered $6 billion bet on wider mortgage spreads actually translate into durable value and higher dividends in the quarters to come? Keep a very close eye on their EAD, because the answer is going to be hiding right there in the cash flow. Thanks for joining this explainer, and we'll catch you next time.